Business Advisory Services update this morning when I'm joined by Paul Barnaby from Beyond Accounting Technologies and Plan Guru. How are you today, Paul?
I'm just great, Peter. Thank you.
Okay, well, we'll just switch across and you're on the screen. So, Paul, we're going to talk today about predictive accounting. This is a new terminology, isn't it? How long's the term predictive accounting been used?
Well, Peter, I'd like to think it's exclusive to me, but research shows that there are a few people using the term. But for me, it just sums up in two words what strategic planning in financial terms is all about. And it's nothing more or less than looking to future periods and producing financial statements, including cash flows for those periods, just the same as we do in the past.
Yes, but it's using accounting skills to look at the future, isn't it? Rather than everything being an historian type recording.
Oh, absolutely. I think the profession for too long has been a bit sidetracked with historic financial information. And when it comes to reports to their companies or clients, they're too used to just saying, well, this is what's happened. It's a bit like driving a bus and trying to look in the rear vision mirror while you go forwards. Just doesn't work.
Yeah, in some ways we've become captive to the bureaucracy, haven't we? The tax office, the corporate affairs, the Australian Security Investment Commission, all these people are primarily only interested in past events. The only one that's got some interest in the future is the stock exchange. They keep on asking companies where they're going to go. And isn't that the way that all businesses should be thinking, the future? The past has already occurred. There's nothing much they can do about it.
Oh, absolutely. My pet saying, if you like, to any business is, where are you now? That's the history. Where would you like to be? That's the future. But the key point in the middle is, how are we going to get there?
Yeah. Yeah.
And that's the key point. How are we going to put in place strategies? But better than that, how are we going to measure what those strategies might look like without actually putting them in place? Let's test them today to see what might happen tomorrow if we put that strategy in place.
Okay, so I know that when you start this type of exercise, we all remember how we were probably taught to do budgets, which was in lots of cases put last year's figures in and add a percentage to it, and away you go. It's not very correct, is it?
Oh, absolutely not. In fact, if I'm to be a little blunt, I usually say to people, a good guess might be better.
Yeah. So in the 3-in-1 budget process, whereby we're looking at budgets, cash flow forecast, and a predicted balance sheet, which is very important. And that's always been a missing link in this whole process, hasn't it? When people just looked at budgets and cash flows, those good guesses you're talking about, no one was probably game enough then to take it through to a balance sheet. But we really need that predictive balance sheet. So we start with the key drivers.
Yes.
In this formulation. Do you want to just work us through on that, thanks?
Oh, absolutely. Just going back to that historic numbers and pitching it forward into next year or the year after. The problem with that is that if that budget doesn't come off, what went wrong? If we've only got $1 budget, what have we got to fall back on if we don't achieve it? And it's all very well to say, oh dear, how sad, never mind, we didn't achieve it. But it hasn't taught us anything. And that's where key drivers come into place. What you might be interested in is I've got a little slide, which if you can allow me to share my screen, I will show you what I'm really talking about. If I can I just share my screen now?
Yeah, I think I've done that for you, yeah.
Good, thank you. And we'll find the slide. Here it comes.
Yeah, it's on my screen now.
Good. So key drivers, what am I talking about, key drivers? What I'm talking about is, let's use the profit and loss as an example. What are we going to sell? How much of it are we going to sell? What price are we going to sell it at? What is the cost? And what are the associated other costs? That's the profit and loss account. But if we're going to take it right through to the balance sheet and then cash flow, as you correctly say, Peter, we need to include the balance sheet. Because if we're just doing a profit and loss budget, that's fine, but we might run out of money while we're making profits.
That's right. And some people do, don't they?
Very many companies have gone to the wall making money.
Yes.
They just don't have it in the bank, and therefore their creditors push them to in some cases, bankruptcy. So I've got a little example here of how a new business is starting up and it's going to sell some widgets. And they're going to start on the 1st of July and they're going to sell widgets for $50. Simple. They also know that it's going to cost them $30 and they're going to buy them externally. They're not going to build them. They also tell me that they will need to have 45 days average stock on hand to meet what they think is going to be their demand. They also tell me that they are going to sell on terms and they think it will take on average 50 days for them to be paid. So a month and a couple of weeks after delivery of the widget or widgets to their customers. They buy them on terms, they pay cash for the initial stock, but then they get 40 days terms from their supplier for the replenishment of stock as they sell it. And they're budgeting on selling 200 units a month. Now, if you were an advisor to a business, what would you do if you were asked these questions? What's the result of all of that? How much profit are we going to make on that? What's the balance sheet going to look like? And what's the effect on cash flow? What would you do? The overall question is, what's the funding requirement? Now, again, back in the old days when all we had was early spreadsheets, I started with a thing I can't even remember the name of before we had Excel. I think it was VisiCalc or something like that. And before that, again, we just used to do it on a piece of paper.
That's right.
But now we have the tools. So unless you've got some questions on that, on those details, I can show you how I've put together the answers to those questions.
Yeah, I think that's a good idea because that will give our viewers an idea of what this 3-in-1 budget process is all about, because you've got the key components there, haven't you?
Sure I have. Now, a lot of people will just reach for their Excel spreadsheet. And I'm going to say, maybe, but it's going to take you 10 times as long to put it together as it would with a purpose-built tool. So why would you bother? I talked about predictive accounting, Peter. And so accounting is the operative word here. Would we use Excel for historic accounts instead of MyOb, Xero, QuickBooks? Of course we wouldn't. So Excel is not an issue. Well, what else is out there? There are a number of tools. I support PlanGuru, which is based in the US, because I think they have the out-and-out best product for the cost. I'm a little bit biased, I guess, but I look at all the alternatives that are out there, and that's why I say PlanGuru is the best one. So let's go and have a look at PlanGuru. And let's go and have a look at the income statement first. So you can see there that I've got a budget already that the sales are going to be 10,000 a month, the cost is going to be 6,000 a month, and we're going to have a gross profit of 4,000. How have I arrived at that? Well, just going back to the slide, we had units. We knew how many units we're going to sell, and we knew the cost price. So using a little tool that PlanGuru's got called non-financial page, you can see there that I've budgeted the sales units of 200 a month, the sale price of $50 per widget, and the cost price of $30. So then it's done a calculation, yes, a little bit like Excel, but within PlanGuru, to say 200 times 50 is 10,000 a month for the sales, and 200 times 30 for the cost is 6,000 a month. And then I've linked that into the income statement. So there's the first use of the key drivers, the units sold, the selling price, and the cost price. But we mentioned the balance sheet and how you need to predict that as well. So here, one of the key drivers, and there's several in here, is accounts receivable. Remember, I said that we were going to give 50 days terms to our customers, and that's what that's doing there. That's how that's calculated. For inventory, remember I said that we were requiring 45 days stock on hand. There's the inventory. That translates to $9,000. Over on the other side of the balance sheet, we said 40 days we were given for replacement of the cost of sales. The units that we've sold, we replace them, and that's how it's costing there at $40 per unit, using that cost of sales calculation. Plan Guru calculates GST for us. So there we've got the GST liability. So back into the balance sheet, there's the net GST showing, and now we've got the cash flow. That's showing in the balance sheet as the net cash result. And you can see there that it's negative 9,9733, negative 5, negative 2, and then it goes off into credit of 2,200. I can have a look at that on the cash flow report. And there we say that there's the results there of the operating activities, and that's where it's all about, and that's translating through to that deficit and then the positive. So coming back to my slide, what's the result on profit? Profit is, let's go back to Plan Guru. Profit is $4,000 a month, or $48,000 for the year. What's the effect on the balance sheet? There's the effect on the balance sheet. So it's calculating the balance sheet right through to the end of the year, and we're going to have a surplus of cash of nearly $31,000, and obviously the profit is showing in retained earnings. Difference between the profit and, of course, cash is the investment in accounts receivable inventory offset by the accounts payable. So cash effect, there was it showing there, and the cumulative cash effect is there, and we can see that in the cash flow. Now, Peter, just to put all of this into context, that little model took me about 15 minutes.
Yeah.
So when somebody rings up, might be my boss in the company, it might be my client in the accounting firm, Paul, I'd like the answers to these questions. We're thinking of selling widgets. I'd bring him back inside half an hour or an hour and say, there's the result for you. Now, what sort of an impact would that have?
Yes, it's bringing the accountant into play as being a key member of the management team of whoever they're working for. If it's an individual client that they're advising, or they're working in a corporation as an accountant or a chief financial officer, they're very much involved. And this is what happens in bigger companies, isn't it? So we're trying through this concept of business advisory services and chief financial officer services to have accountants far more involved in the day-to-day business matters of their clients, being able to give the answers.
Oh, absolutely. And it's not only important to do it regularly, it's important to do it at timely intervals. Too many businesses, even some quite large, still only do a complete financial report to their board once a quarter. How can you run a business if only 4 times a year you get the key strategies or the measurement of the key strategies that are going to lead to that result that the shareholders want?
And especially in public companies where you've got the continual reporting requirements now for listed public companies, but in lots of ways that same attitude should be adopted by smaller businesses, shouldn't it? That the directors are in a position where the management team are keeping them informed at least every week what's happening in the business. Because if they were a public company and something happened to this morning, by this afternoon, that needs to be reported to the stock exchange.
Yes.
That's the world they live in now. And that's why they need these sort of tools.
Is it as quick as that, is it?
If it's something that might have a material effect on their share price or whatever, if they're aware of it, that's to stop leaks happening in the marketplace and people running in to buy shares when they might have some knowledge that the rest of the market hasn't got.
Yeah, yeah. You're absolutely right, Peter. It's a question of reaction, and the large companies are lucky that they have their onboard CFO, Chief Financial Officer. And in most cases, I talk about the top 100 companies. Every top 100 company that I've ever looked at is using predictive accounting. And many others, of course, that are stock exchange registered, because for the reasons that George is saying, it's a compulsive thing. They have to do it. Having said that, those that are not using predictive accounting, whether if they're not listed on the stock exchange, they don't have to, of course, they are at a huge disadvantage to their competitors out there that are. So that's the point for the companies that have got their on-board CFO. But I don't know how many small businesses there are around Australia. It's millions and millions, I know. And most of them are not big enough to have their own CFO. And sadly, their advisors, maybe they only see them once or twice a year. And coming back to that comment I made about the interval, if they're not reporting budgets against actual, at least on a quarterly basis, but definitely, hopefully on a monthly basis, they have a disadvantage. And this is the point I make to practicing accountants. Get out there to your clients, take the leap, because it is a leap for many of them. They've been preoccupied with COVID-19 and compliance and tax returns. But hey, tax returns are being done early, I'm told, out there. The compliance of tax returns lodged is way ahead of where it was last year. Do you know why that is, Peter?
I think it's because clients of business operators have had more involvement with the accountants. So they're saying, well, we've got all this ready now. Plus, yes. I think it's a little bit because the business operators have got some fear as to what next year might be going to bring. So they want to get into this predictive accounting mold. They now want to get the information. It's a great opportunity for accountants to be able to do what people like you and I and Andrew Geddes and David Smith and Mark Holton have been talking about, and others have been talking about for 30 years in trying to use this technology and communications to be able to have the public accounting industry, the chartered accounting industry, being more involved as virtual CFO for SME clients.
Yeah. And that's why I mentioned the compliance thing, because the lodgements are way ahead from what I understand. And that's going to give that huge opportunity for those very accountants who have lodged their clients' returns early next year to be absolutely ready to go when that client says, well, where's my budget? Or what's going to happen this year? Or we don't think we can do more than half our last year's turnover. What's going to be the result of that? These are the questions that will come out. And if we're going to do half the turnover that we did last year, I know of companies that are doing half the turnover and are making more money.
Yeah, that can happen at times because they become more efficient. They become more efficient and gain efficiencies. Well, this whole process, though, helps in other areas also, doesn't it? Being able to do predictive accounting, because what it's also going to show in a business is if the business has been undertaking, say, some expansion or a major research and development activity that's taking up a lot of money and time, the company might show in these predictions, gee, we're going to do all this, or even just a business expansion because they need more investment in stock and debtors. Their cash flow forecasts that we've now prepared may well be showing they haven't got enough money. They can't continue to operate in that fashion. They haven't got a bank overdraft facility. So what do they do then? They probably look around to see if they've got any spare assets they might be able to mortgage to a bank, or they could take the opportunity of saying, well, we don't want to borrow any more money. We will see if we can raise some capital, because private companies can raise capital as long as they go about it in a proper manner. Is this how you see it, Paul?
I absolutely do, Peter. And I think your last few words were the key ones, in a proper manner. If they go to a bank to raise some money, what are they going to have to do? They're going to have to produce some predictive accounting statements.
That's right.
If they go to raise some capital on the stock exchange or anywhere else, what are they going to have to do? Produce some predictive accounting statements. If they're going to raise money privately, what are they going to need? A proper business plan, including some predictive accounting statements. Wherever you go, wherever you look, not only do they have to measure how much they need, but they have to satisfy the provider of those funds that their investment will be safe. So it goes even beyond the investment or the borrowing or what it might happen to be. It goes beyond continuing those predictive accounting forecasts to show what is going to be the effect of that funding or bank overdraft or whatever it might be. And I think too many accountants also, and this is, I know, one of your topics in your list, is the ability to raise money from equity in the smaller businesses. You might like to comment on that.
Yes, well, 3 years ago, Australia played a significant catch-up. The then Prime Minister, Malcolm Turnbull, introduced the innovation statement. And from that, we had created the concept of 2 new types of companies: early stage innovation companies, which enable a small company that has developed a new product, process, service, marketing, or management methodology to be able to raise capital. And it's great for the company, they can raise capital. But the government knew that those small unknown companies needed some attraction. So the attraction that the government offered was, if investors invest in those companies, they can obtain a tax rebate calculated depending whether they're a sophisticated investor or a retail investor, but they can gain 20% of their legitimate investment amount. And if they hold those shares for more than 12 months, they escape capital gains tax. So that's a nice carrot to help those people. But if you're going to be dealing with those types of investors, you definitely need predictive accounting. You need, and because this is an unknown company, probably got no track record at all. It's never been in business. All they've been doing is doing research and development. A bit like that group that's announced this morning that they have a product for COVID-19 out of Brisbane that I saw on this morning's news. Now, I assume they've already attracted some investors. I hope they have. But if not, and they're now out looking for investment funds, they will have to be producing projections on what they're going to be able to produce and what it's going to be able to be sold at. They've entered into contracts, I noticed, with the American government. They're going to send 100,000, I think it said a week, of doses or packages, whatever they are. So it just shows you that companies that are young are doing things, some of them very exciting things, but they will need this predictive accounting infrastructure put around them so that they can give investors some satisfaction that the directors and senior management team have got some idea where they're going.
Absolutely, I agree, Peter. We're each preaching to the converted. I know that.
Preaching to ourselves. And the other one, of course, is crowdsource funding, which is far better known because it appeals to a wider group of businesses. The only turnover limit is $25 million, and the company can raise up to $5 million. So that basically includes a whole range of small businesses, small, medium-sized businesses. And companies can go beyond that, just that they've got to start looking at initial public offers. And if you're going to go down that path, you definitely need these forecasting tools. You need budgets and cash flow forecasts and predicted balance sheets in the material that you're making available to your potential investors. So that's where we see it headed, Paul. I hope that in 2021, there's going to be a lot more interest in this. I get the feeling that there's an upsurge of interest in a whole range of these matters from both accountants, but also from clients, SME clients. I've had more inquiries from businesses within my consulting business in the last 3 or 4 weeks than we've had for most of this year. and it's people wanting to do things in 2021, but they're going to need these reports prepared and proper guidance given into them, not just slotting figures into a computer and looking at it, but then the figures need to be evaluated. The leadership team of the company need to be signing off on them, that they're happy, that they've been through the key drivers, which is one of the key areas, I think, for the leadership team to say,
Absolutely.
yes, we can sell or we can produce 100 widgets a day or whatever the figure is, and we can sell 100 within 40 days or whatever. That's very important that they've got buy-in to this whole process, isn't it?
It is. And Peter, the last thought I'd like to leave with you for the accounting practices that might be watching this video is, if you're asked to do a set of predictive accounting statements for a client, maybe for a loan application or what have you, don't finish it off, give it to the bank, get the loan and say it wasn't that great and put it on the shelf and forget it. Use the opportunity to involve those staff owners in the business to continually review that budget. Did we achieve it? If we didn't, why not?
Yeah,
if
good point.
If you've only got a dollar budget, you can't review against anything. That's why you need to use those key drivers. So key drivers, proper financial statements into the future, profit and loss, balance sheet and cash flow, I believe will be the key to recovery in 2021.
I agree with you, Paul. And on that note, I think we'll say to our accounting colleagues, good luck. We're happy to talk to you. Obviously, Paul is the representative in Australasia and Asia for Plan Guru. So you're very happy to talk to accountants about the formal software that you represent in Australia and New Zealand. But also wearing your other hat, you have a consultancy business that can run training sessions and guide people in this process.
Absolutely.
Within ESS BIZTOOLS, we have got packages to cover crowdsource funding and early stage innovation companies and a whole range of chief financial officer services. So there's no excuse. The tools are there. If you really want to offer these services to your clients, and a lot of your clients are looking for these sorts of reports to now be prepared for them, we look forward to talking to you in 2021. So thanks very much, Paul. All the best for Christmas. And
same to you, Peter.
I'll be glad to see this year finished, to be honest. And we really hope that 2021 is going to be a great year for Australia, for accountants, for our clients, and for the world.
Thanks, Peter. Thanks for joining with me
Thank
this
you.
morning.
Okay, bye-bye.